Hey friends, welcome to today's Singapore Market Digest. I'm Iggy from the Investing Iguana, and today we're looking at some interesting movements in the Singapore market. Let's dive right into the action with several key companies making headlines today. Semcorp Industries has hit a roadblock with one of its gas import deals. Their subsidiary, Sembcorp Gas, had an agreement to import natural gas from Indonesia that has now fallen through. This deal was originally announced back in September 2023 and would have allowed them to import up to 111 billion British thermal units of piped natural gas daily from the Mako gas fields in Indonesia. The gas delivery was supposed to start in 2026, but unfortunately, they couldn't secure the necessary regulatory approval from Indonesia. The company partners in this deal included West Natuna Exploration, Empyrean Energy, and Coro Energy Duyung. Despite this setback, Sembcorp has reassured investors that this won't significantly impact their earnings or net tangible assets per share for the financial year ending December 31st, 2025. This is good news for shareholders who might have been concerned about potential financial implications. Looking at their stock performance, Sembcorp shares closed at $6.09 yesterday, up by 0.7% or 0.04. This slight uptick suggests that investors aren't too worried about this development. For those unfamiliar with Semcorp Industries, they're a leading energy and urban solutions provider with a strong presence in Asia. The company focuses on providing sustainable solutions across various sectors, including energy, water, and urban development. Their energy portfolio includes conventional energy as well as renewables, which has been a growing focus for them in recent years. From a technical perspective, Sembcorp has been showing resilience despite this setback. The stock has maintained its upward trajectory, suggesting investor confidence in the company's overall strategy and diversified business model. Their pivot towards sustainable energy solutions has positioned them well in the current market environment, where ESG considerations are increasingly important. When we look at trading volumes, Sembcorp continues to see healthy activity, indicating sustained interest from both institutional and retail investors. The company's strong balance sheet and dividend history make it an attractive option for income-focused investors in Singapore's market. Singapore Post, or SingPost as we know it, has received overwhelming shareholder support for its divestment of Australian logistics business Freight Management Holdings, FMH. An impressive 99.9% of voting shareholders approved this sale, which is a clear vote of confidence in management's strategic direction. The sale to Australian private equity firm Pacific Equity Partners will bring in a $775.9 million in gross proceeds and generate a capital gain of approximately $289.5 million. That's a substantial windfall that could significantly strengthen SingPost's financial position. What's particularly exciting for shareholders is that the board is considering paying a special dividend from these proceeds. This potential cash return makes SingPost an interesting watch in the near term. With the FMH sale, SingPost will now focus on its core Singapore postal and e-commerce logistics business, along with its international e-commerce logistics operations. This strategic narrowing of focus could help the company optimize its operations and improve efficiency. Looking ahead, SingPost has announced plans to invest $30 million in new, fully automated e-commerce parcel sorting equipment at its regional e-commerce logistics hub in Tampines. This upgrade is expected to be completed by mid-2026 and should enhance their operational capabilities significantly. They're also planning to vacate about 83,000 square feet of lettable industrial space at the SingPost Center in Paya Lebar, which could help streamline their real estate footprint. SingPost shares responded positively to these developments, closing 2.7% or 0.015 higher at 0.565 yesterday. For those who might not be familiar with SingPost, they're Singapore's national postal service provider with a history dating back to 1858. In recent years, they've been transforming from a traditional postal service into a modern logistics and e-commerce solutions provider. This strategic pivot has been necessary as traditional mail volumes decline globally while e-commerce continues to grow. From a technical standpoint, SingPost stock has been in a consolidation phase for some time, but this positive news could potentially trigger a breakout. The increased trading volume we've seen recently suggests growing investor interest, particularly with the prospect of a special dividend on the horizon. REIT has made a significant move in the debt market, pricing $125 million in subordinated perpetual securities at 5.75% under its $750 million multi-currency debt issuance program. This is an interesting development for the industrial REIT. For those wondering what perpetual securities are, think of them as a hybrid between bonds and equity. They have no maturity date, hence the term perpetual, but they pay regular distributions, like bonds. They're a way for companies to raise capital without diluting existing shareholders or taking on traditional debt. REIT plans to use the proceeds from this issuance to refinance existing borrowings or to fund new acquisitions and investments. This gives them flexibility to optimize their capital structure or potentially expand their portfolio. The distribution rate on these securities will be reset on March 20th, 2030, and every 5 years after that. The reset rate will be calculated as the Singapore Overnight Rate Average Overnight Indexed Swap plus the initial spread of 3.5112%. Holders of these securities will receive distributions in arrears and have the option to redeem them on the first reset date or any distribution payment date after that. REIT units closed up 2.1% or $0,005 at $0.240 yesterday before this announcement was made. For those not familiar with REIT, it's one of Singapore's largest industrial REITs, with a diversified portfolio of properties including logistics facilities, high-spec industrial buildings, business parks, and general industrial properties. The REIT focuses primarily on Singapore but has been exploring opportunities in other markets as well. From an industry perspective, industrial REITs have been relatively resilient compared to other property sectors, supported by the growth in e-commerce and logistics. REIT's focus on new economy assets positions it well to benefit from these structural trends. Looking at the technical indicators, REIT has been trading in a relatively tight range recently. The successful pricing of these perpetual securities could provide some positive momentum if investors view it as a sign of financial flexibility and strength. City Developments Limited, or CDL as it's commonly known, saw its shares surge yesterday following some interesting corporate governance news. The stock jumped 3%, or 0.15s to close at 5.09. The catalyst for this move was the announcement that Executive Chairman Kwek Leng Beng will be discontinuing his lawsuit against his son and CEO Sherman Kwek, along with 6 other members of the CDL board. This resolution of what appeared to be a family and corporate governance dispute has clearly been received positively by the market. For those who might not be familiar with CDL, it's one of Singapore's largest property developers with a global footprint. The company has a diverse portfolio spanning residential, commercial, retail, and hospitality properties across Asia, Europe, and North America. Founded in 1963, CDL has been a significant player in shaping Singapore's skyline and has expanded internationally over the decades. The Kwek family, through the Hong Leong Group, maintains a controlling interest in CDL, making this legal dispute particularly noteworthy. Family-controlled businesses sometimes face unique governance challenges, and the resolution of this dispute removes a significant overhang for the stock. From a technical analysis perspective, CDL's stock has been in a general uptrend this year, with yesterday's move potentially signaling a breakout from recent consolidation. The increased trading volume accompanying the price jump suggests strong investor interest in this development. In terms of the broader property market context, Singapore's real estate sector has been showing resilience despite higher interest rates. CDL's diverse portfolio across different property segments and geographies provides some buffer against localized market downturns. Looking ahead, investors will likely be watching for any further details about the resolution of this dispute and its implications for CDL's corporate strategy and governance. The company's upcoming projects and financial performance will also be key factors to monitor. There's been an interesting development in the Singapore REIT sector, with JPMorgan upgrading its rating on Singapore-listed real estate investment trusts from underweight to neutral. This upgrade is primarily driven by declining treasury yields, which typically benefit yield-sensitive instruments like REITs. When treasury yields fall, REITs become relatively more attractive to income-seeking investors. Additionally, lower interest rates reduce borrowing costs for REITs, potentially improving their distributable income. This sector-wide upgrade could signal a turning point for S-REITs after a challenging period. JPMorgan has highlighted several top picks in the sector. These include Capitaland Ascenda's REIT, A17U SI, which is Singapore's largest industrial REIT, with a diverse portfolio of business and science parks, logistics properties, and industrial facilities. Another pick is Capitaland Integrated Commercial Trust, C38U SI, which owns a portfolio of quality shopping malls and office properties primarily in Singapore. Fraser Centrepoint Trust, J69U SI, also made the list. This REIT focuses on suburban retail malls in Singapore, which have proven relatively resilient due to their focus on essential services and proximity to residential areas. Keppel DC REIT, AJBU SI, which specializes in data centers globally, rounds out JPMorgan's top picks. Data centers have been a growth area driven by increasing digitalization and cloud computing adoption. DBS Group Research has its own set of preferred REITs, which includes some overlap with JPMorgan's list. Their picks feature Capitaland Integrated Commercial Trust, Fraser Centrepoint Trust, Keppel REIT, K71U, SI, Mapletree Industrial Trust, ME8U, SI, Mapletree Logistics Trust, M44U, SI, and Parkway Life REIT, C2PU, SI. For investors interested in the retail and industrial segment specifically, these recommendations provide a good starting point for further research. Retail REITs have been recovering as foot traffic returns to pre-pandemic levels, while industrial REITs continue to benefit from supply chain reconfiguration and e-commerce growth. From a technical perspective, many S-REITs have been forming potential bottoming patterns after extended downtrends. The sector has underperformed the broader market for much of the past 2 years due to rising interest rates, but this trend could be reversing if rates have indeed peaked. Trading volumes across the S-REIT sector have been picking up recently, suggesting increased investor interest. The distribution yields for many of these REITs remain attractive compared to fixed income alternatives, especially with the prospect of interest rate cuts on the horizon. Taking a step back to look at the broader Singapore market, we're seeing some interesting trends emerge. The Straits Times Index has been showing resilience despite global uncertainties, supported by the banking sector and select blue chips. The developments we've discussed today highlight several key themes in the Singapore market. First, we're seeing strategic corporate actions like SingPost's divestment of its Australian business, which demonstrates companies' focus on optimizing their operations and capital allocation. Second, the resolution of governance issues at CDL reminds us of the importance of corporate governance, particularly in family-controlled businesses that are common in Singapore and across Asia. Third, the upgrade of the S-REIT sector by JPMorgan suggests that we might be at an inflection point for interest rate-sensitive sectors. If interest rates have indeed peaked and begin to decline, we could see renewed interest in yield plays like REITs. For investors looking ahead, it's worth considering how these themes might play out in your portfolio strategy. Companies with strong balance sheets and clear strategic direction, like we've seen with SingPost's focused approach, may be well positioned in the current environment. The industrial and logistics sectors continue to show resilience, as evidenced by ESR REITs capital raising and the analyst recommendations for industrial REITs. These sectors benefit from structural trends like e-commerce growth and supply chain reconfiguration. As always, it's important to do your own research and consider how these investments fit into your overall portfolio strategy and risk tolerance. The companies and trends we've discussed today offer interesting opportunities, but they should be evaluated in the context of your personal investment goals. That wraps up today's Singapore Market Digest. I'm Iggy from the Investing Iguana, and I'll see you in the next update. Happy investing, friends!